have things officially soured? What's your take?
Right. So I think that that's the first question investors need to ask is, are they still investors in the market before they even get to the tech piece? Because to just be an investor in the market today, you're owning 25% tech. It's everywhere. So you need to see if you're comfortable with that. We still are. Then once you get into like what sectors, if you're going to be investing in the market, and I was just sitting with some of our institutional clients out in Seattle, large family offices, there is a sentiment, I think, across the entire country that if you're going to be invested in equity markets still, you'd like to be a little bit more defensive here. Not just because of the volatility we've seen since February, it's because we're in the later stages of an economic cycle.
So what does that mean, being defensive?
So it's a great question specifically today because defensive used to mean high dividend stocks. It used to mean utilities. But when you think about that today, those sectors of the market are highly sensitive to interest rates rising. And in this particular bout of volatility, the volatility is coming with interest rates rising, albeit not today, but throughout this period. And so those are not what the best poised. So in our view, the best defense is a good offense in today's market. So you want companies which are high quality, running at lower leverage, and have good growth potential. And a lot of that still is tech.
Despite the last few weeks.
Despite the last few weeks. And now that's not to say that there isn't going to be noise, and that's not to say that we're in any way dismissing the regulatory concerns or the concerns around trade. Those are real. But from a pure fundamental ability to earn, it still exists in tech.
Now, I know you can't speak to specific names, but if you look at what's happened with Facebook, if you look at what's happened with Amazon, do you think that companies like that are going to weather this storm and that this is just a blip?
So where we would be focused as of today, as of right now in tech markets, is those enterprise technology companies which could sell directly to corporations. As we look at what's going on in corporations today, it's distinct from what's going on in the consumer. Corporations are looking at a windfall from this most recent tax bill. And as we analyze the text from corporate conference calls across the industry, you are looking at, across the entire United States, a huge round of tech spending which is coming, simply because it's been put off for years and years at this point, and it's now coming in. And so those companies which are selling to other companies are the best poised to see earnings growth, or sales growth rather, into this.
So not necessarily a Facebook, but Amazon potentially, because they have AWS and a B2B business there.
Right. Yes, absolutely. When you're looking at selling directly to companies who are augmenting their tech platforms are very outdated right now across the board.
So what's happening in the private markets? Because you have exposure across the board, whether it's venture capital, whether it's, private market startups like Uber. I know Blackrock has a big holding in Uber.
Right.
Talk to us a little bit about what sort of activity you're seeing there.
Right. So from our family office clients, who are secretly they run with semi-permanent capital, very below the radar, and they don't need to be doing what the herd is doing in terms of keeping up with their peers. They can be very specific. They are continuing to hold private investments and continuing to look for private investments. I would say that has backed off from years past where you were looking at VC investments or even kind of later stage private equity investments in tech. But you're actually looking at some investments into companies which are not necessarily technology companies, but are beginning to utilize technology more in their businesses. Those are poised to advance, and they're looking at investments in private companies which take advantage of that. There is still a very, very, I would say, strong interest in private investments, partially because, as you've seen central banks create wealth to the extent that they have, create money to put into public markets, those private markets have not been the recipients to those to as great of an extent. And so we could still see some pockets of opportunity, and people are looking for things which are a little bit idiosyncratic, so they don't necessarily go down when the broader market goes down.
So there's a lot of uncertainty, especially when it comes to the administration, potential trade war, tariffs, potential regulation for, some of these big tech companies could be facing regulation. How are you taking that into consideration?
So it is very hard to price that in. To kind of predict the next move from a policy or regulation standpoint has traditionally been very hard, and that's definitely still the case today. But I would, if I were an investor, and what we've been talking to investors about, if you're concerned with the state of U.S. regulatory policy or trade policy, perhaps look beyond the borders of our own country. If you think about it, the tech sector is a global sector, and the U.S. tech companies are running at a forward earnings at about, call it, 17 and change, which is not it's not too far off 5-year averages of the broader market. In emerging Asia tech, those numbers are different. It's something closer to 14 times forward earnings, which still isn't very different than the broader market. Yet they're leading in some cases in very interesting segments of the market. And from a regulatory perspective, they're not seeing changes because they've been under a different regulatory regime since the beginning. And so we're not worried about changes there. It's more status quo over there. Right. Now, I would raise a little bit of caution because you're up against some pretty high comps, especially with Chinese earnings cycle. They had an incredible earnings cycle last year, which you're going to be looking at comping yourself against. So some caution potentially in the near term around some choppiness, but long term it looks great.